Hello everyone, welcome back. Now that we've learned to identify business gross income and deductible expenses, now we need to match the income and the deductions to a specific period. And the accounting methods allow us to match the income and expenses to that specific period. So just to start off this section, because we're going to be talking about business accounting methods, here we'll just introduce some basic terminology related to accounting periods for a business for tax purposes. So for the annual periods, a full tax year is typically 12 months long, whereas a short tax year is less than 12 months long. And then for year ends, there are a few different types of year ends that a business could have. So if they have a calendar year end, that means their tax year ends on 12/31. Or they could have a fiscal year end depending on what they decided to choose. So if they had a fiscal year end, that would mean that their year end falls on the last day of a month that is not December. So for example, when I used to work at Monsanto before they got acquired by Bayer, their fiscal year was September to August to follow the farming season. So their fiscal year ended on a month that was not December. The other option a business could have is a 52 to 53, or I guess 52/53 week year end. And so what that means is that it is a fiscal year that ends on the same day of the week that is the last such day in the month, or on the same day of the week nearest the end of the month. So the example that the textbook provides is if a business adopts a 52/53 week fiscal year, they could adopt a fiscal year where it ends on the last Saturday in July of each year, or it ends on the Saturday closest to the end of July, with that Saturday potentially falling in August rather than July. So when choosing an accounting period for a business, the options that are available to you typically depend on the type of business entity that you have. So as the slide mentions, for the most part, proprietorships have the same tax year as the proprietor's individual tax year end. For C corporations, they get to choose on their first tax return whether they want to use a calendar, fiscal, or a 52/53 week year end. And usually they try to pick something that is consistent with the book accounting period, or their financial accounting period. Flow through entities then, so partnerships, S corporations, those have a required tax year. And typically those tax years try to be consistent with the owner's tax periods. And so for a partnership where there could be multiple owners or multiple partners, we can kind of see how that could get a little more complicated than a sole proprietorship, for example. A business typically adopts their fiscal year end whenever they file their initial tax return. And then once a business establishes their tax year, they typically have to receive permission from the IRS to change that tax year. Also, something to keep in mind, because the real world isn't perfect like a textbook scenario. For most businesses, the first year of that entity is typically a short year, because we can start a business at any time. The activity doesn't have to occur on January 1st of whatever year, so just something to keep in mind. Typically that first year can be a short year. It doesn't have to be a full 12 months for the business. So if we turn on our financial accounting brains for a second and then compare financial accounting to tax accounting methods, it's helpful to see the distinction, because the approach to financial accounting is very different to tax accounting. And those differences can typically influence the methods of accounting that we use under each type, so financial versus tax. So typically for financial, the main purpose that we want to get out of financial accounting is we want to try to make our net income, our bottom line, as large as it can be, because then we would want shareholders to invest in us, or outside investors to invest in our company. And so the way that we would do that on the GAAP side is we would want to accelerate our income, so bring in more money now, and then defer deductions. So we'd want to pay for things later, or pay for things as late as we possibly can without incurring penalties and whatnot. For tax accounting, on the other hand, a goal for tax accounting is we want to reduce the amount of taxes that we owe and also grow our after-tax wealth. And so the way to achieve that is exactly the opposite of financial accounting methods. So we want to defer income. So we want to delay paying taxes on our income for as long as we possibly and legally can. And then also we want to accelerate our deductions. So from the tax accounting perspective, we want to pay for things as early as we possibly can, so that way we can increase our deduction numbers and then essentially lower our taxable income as much as we possibly and legally can. So for tax purposes, the overall accounting methods that businesses are allowed to use are cash and accrual basis. So both of these methods, which we'll talk about over the next couple of slides. Cash, that basis, you recognize income whenever it is received. Whereas under accrual, you would recognize income when it is earned or received, whichever is first typically. For the most part, businesses can choose either method. However, large corporations and partnerships with corporate partners are typically required to use the accrual method, especially if they do not qualify as a small business under the gross receipts test that we talked about several slides ago. So then kind of continuing that thought, if the taxpayer does satisfy the gross receipt test, then they can elect to use the cash method for their accounting, and they do not need to request permission from the IRS to do so. Additionally, it's not listed on here, but there is a kind of hybrid or mixed accounting method that businesses can use. It's technically classified as a form of the cash method, but what it is, or I guess why it's called a hybrid method, is because under the hybrid method, businesses can choose to account for some accounts on the cash method and then other accounts on the accrual method. So essentially it's just like it sounds. It's combining both methods together. So when we think about the two methods in detail, we'll think about the cash method first. So under the cash method, we did talk about the income piece a little bit on the previous slide. So income is typically recognized when it is actually or constructively received. And then expenses are recognized when they're paid. So when I think about the cash method, I literally will picture a dollar bill and then think about, okay, when am I actually receiving this dollar bill? When am I actually giving this dollar bill away to pay for something? So then that helps me think about the timing of events for the cash method of accounting for tax purposes. So there are pros and cons to both methods, and so we'll talk about each of those. So for the cash method, some pros for adopting the cash method are: it is flexible, it is simpler to use, and it's relatively inexpensive. You can use accrual for some accounts, so it allows for that hybrid accounting. It can be used by taxpayers who satisfy that gross receipts test. So I feel like that kind of rolls into the flexible, simple, and relatively inexpensive bullets. Because if you're a small business owner, if you're like maybe waiting to hire an accountant for a little bit, the cash method can be simple enough to allow a business owner that is just starting out to easily track their income and expenses. However, probably the biggest con of the cash method is that it's poor matching of income and expenses. So I think back to my intro to financial accounting class where we talked about the differences between cash and accrual accounting on the financial side. That same kind of methodology applies to tax accounting too. Whereas, so for accrual accounting, typically the accrual method is a little more superior when it comes to matching income and expenses together in the proper periods. So when comparing to the accrual method, under the accrual method, income is recognized when it is earned or received. And so usually that is when the all events test is met. And so that all events test, it recognizes the income when all the events have occurred that fix the right to receive such income, and the amount can be determined with reasonable accuracy. So what that means is assuming the amount of income can be determined with accuracy, businesses meet the all events requirement on the earliest of these three dates. Whenever the service or sale is complete, whenever payment is due, or whenever payment is received. So let's look at an example demonstrating that. So in our practice question, Ben provides consulting services and bills Ace for $12,000. Ace disputes the amount, claiming that $8,000 is the proper amount. How much income should Ben recognize under the accrual method this year? The amount that Ben should recognize is $8,000. It's this number here. And the reason why is because that revenue is contingent on claim, or another way to say that is it is under dispute. Under the accrual method, something that we would have to deal with for tax purposes is prepaid income, or in financial accounting classes, we might call it unearned income. So essentially, just as a reminder of what that is, as a business, we received payment in advance for goods and services that we haven't provided yet to the customer. So it's technically a liability because we owe them some sort of good or service. So typically, accrual method businesses are allowed to defer the recognition of that unearned or prepaid income for 1 year unless that income is earned or recognized in the financial accounting records. This rule is not applicable to payments for rent or interest income. So typically rent and interest are recognized immediately upon receipt, even if it hasn't been earned yet. And then additionally, this accounting method election for prepaid income is something that cannot be changed without the IRS's permission. So let's look at an example that demonstrates that concept. So in our example, Ben provides dancing lessons. On September 30th of this year, he received $2,400 in full for a 2-year service contract. What amount of income must Ben recognize if he is on the cash method and if he's on the accrual method? So under cash, Ben must recognize the income as it is received. So then for the cash method, the amount of income that he will recognize this year is the full $2,400 because it was received on September 30th during the year. Under the accrual method, Ben can elect to defer the advance payments for 1 year. So for this year, the amount that Ben would recognize is $300. And the way that is calculated, if we take the $2,400 and then divide that by 24, because that $2,400 was for a 2-year service contract. And then we multiply that by 3 months. So the payment was received on September 30th. And again, I will reiterate that exam tip again. Pay close attention to your dates, because that will dictate how many months you need to consider for the expenses. So since the payment was received September 30th, the months that we are considering are October, November, and December for the year. So that's 3. So that is for this year. Then a subsequent question for the accrual method is, how much would be recognized next year? So I will write that out separately. So accrual method next year. And the amount that can be recognized next year is the remaining $2,100. And that is because income can only be deferred for 1 year. For inventories, the key factor we need to keep in mind is that inventories generally must be accounted for under the accrual method if the sale of goods is a material income producing factor for your business. And so typically that accrual piece, that would mean that our sales are being accrued with some sort of accounts receivable and our purchases are being accrued with some sort of accounts payable. Cash method taxpayers can use the cash method for other non-inventory accounts. However, the big key here is if inventory and the sale of goods is an active part of your business, you need to use the accrual method. So since we discussed inventory, we have to talk about the inventory flow assumptions as well. And in this topic, probably the most important thing to note is that for LIFO, the only way a business can use LIFO for tax purposes is if they also use LIFO for financial reporting purposes. And so that's called the book tax conformity rule. And the reason why this rule exists is because whenever you are in an inflationary environment, LIFO generates the lowest taxable income during that time. Whereas for financial reporting, FIFO would be the most beneficial for a business to select. So because of that and that huge benefit that a business could have, if they want to pick LIFO, they have to use it for both book and tax. The last topic that we're going to talk about in this chapter is accruing for business expenses. So whenever we're doing that, it'll create a liability. And so whenever that happens, to claim a deduction for an accrued expense, that expense must meet 2 tests. The all events test, which those details are on this slide, and an economic performance test, which we'll talk about in more detail on the next slide. So for the all events test, it is very similar to the all events test for recognizing income. And so for the all events test, all events have to have occurred to establish the liability to pay. The amount should be able to be reasonably determined with accuracy. And then additionally, reserves for future liabilities are not allowed. The second test we have to meet is economic performance. And what economic performance means is that the activity that created the liability has to have occurred in order for the associated expense to be deducted. So the way that test is satisfied depends on how that liability came into existence. So if the taxpayer provides goods or services, then performance occurs whenever the taxpayer provides those goods or services. Whenever a taxpayer is receiving goods or services, performance occurs as the goods are provided to the taxpayer, or the taxpayer makes a payment and then the economic performance from the other party is expected within 3.5 months of that payment. For payment liabilities, that economic performance occurs when the liability is paid. So some examples of those types of payment liabilities might be workers' compensation, taxes, rebates and refunds, and then items like interest and rent occur ratably. Let's take a look at an example of an economic performance example. So Ben has signed a binding contract for Peter to provide Ben with repair services. Ben paid $1,500 to Peter and owes an additional $6,000 on the contract. The repairs will commence late next year. When can Ben claim the deduction if he uses the accrual method? So in order to claim the deduction for an accrued expense, we need to satisfy the all events test and the economic performance test. So if we consider the all events test first, the all events test is satisfied because Ben signed the contract. So signed a contract. However, whenever we look at the economic performance test, economic performance has not been satisfied because the repairs won't start until late next year. So then, to answer our question, when can Ben claim the deduction if he uses the accrual method? Ben can deduct $7,500 next year because that's when economic, I'll abbreviate it as ECON, economic performance is satisfied. All right, guys, that is the end of chapter 9, and I will see you in class next week.